Good day and welcome. Thanks for joining us on our webinar. We appreciate the time. Today I am joined by Deborah Slubber and Renee Swanepoel from Morningstar. They are our partner in the Citrine range of funds. We're going to be discussing markets, looking back at 2023, looking ahead to 2024 more broadly, and then we're going to do a bit of a deep dive into the Citrine range of portfolios, how well they've done, why we think they've done so well, and what the future looks like for the South African investor with Citrine in mind.
So Citrine is by definition an orange wealth stone. It's referred to as the merchant stone or the success stone, and it's supposed to bring prosperity and abundance to those that carry it. Citrine and orange is in our branding, so it seemed like a perfect fit. And to date, the Citrine portfolios really are delivering abundance and prosperity to our clients.
So Citrine is it's a range of portfolios, all multi-manager. What we've done is we've partnered with global research giant Morningstar, just a household name, somewhere north of $220 billion in assets under management, and I think it was a very easy decision to choose to partner with them. They're a discretionary fund manager, so we wanted to put together these portfolios which are dynamically managed. They sort of move and tilt over time, depending on what the situation is in the market. And we wanted to bring something a little bit newer and a little bit fresher to what is quite a saturated space in SA. So it offers a few things which we think are very important individually, but very powerful collectively. So we've got 5 portfolios across the range, right across the risk-return spectrum. So if our clients are looking for an investment for 6 to 12 months, we have a solution for that. For most of our clients who are looking for a long-term investment, we've also got a solution for that. The portfolios are independently constructed using specialist managers who tend to outperform during different market cycles. So we have a range, so it almost doesn't matter who the client is. We have a solution that should fit with that particular client's investment objectives and goals. So the Citrine range comprises 5 portfolios, each with different mandates. So if you look at there's Citrine Income, which is, as the name suggests, an income portfolio. So what that fund is similar to a money market fund, but slightly elevated returns. We then have a conservative, a moderate, and a balanced portfolio, each one with an equity portion that is sort of higher as you go up. All 4 of those are Regulation 28 compliant, so you can use them in preservation funds, retirement annuities, which is where the bulk of our investments lie. And then the final one is Citrine Flexible. That is the broadest mandate, and that basically is a global, worldwide mandate. So looking for opportunities across the globe. That one isn't Regulation 28 compliant. It's definitely the one that has the most equity, and it's one if you are a long-term investor looking for something a little bit more adventurous, a little bit more aggressive. It's that type of portfolio. So, Renee, let's kick off with you. 2023 is now in the rearview mirror. Some goods, some bads, some shocks. So from Morningstar's point of view, from you sort of putting our portfolios together, what went right, what went wrong, what calls, what calls were good, were bad, and essentially what did we learn?
If we look at 2023, it's definitely a year that we learned quite a few lessons. These lessons probably stay the same. If we look at every year in markets, it really is the same lessons. But there were 3 big things when you look at 2023. The first is that prediction adds very little value. 85% of economists said we're going to go into a recession in 2023. If you were a rational investor, you would have probably wanted to sit in cash. You would have missed out on about 10% return if you weren't invested in equity. The second really is that markets never move in a linear fashion. I think as investors, we think when you get into the market, it's only going to go one way and that's up. And that's not the reality. And a lot of your returns is actually made up in a very small part of your investment horizon. And I think the third lesson really is that volatility is a very bad indicator of risk. Risk is what's left after you think you've thought of everything. So I think those are probably the 3 things when I look back at 2023 that I think are good lessons for us as investors.
We are in 2024, and it is going to be an interesting year for a number of reasons. We've got no fewer than 60 countries having elections, so 4 billion people going to the polls this year. We've also got the highest number of countries, 78, with a debt to GDP ratio of more than 100% going into 2024. So from your point of view, looking at 2024, what do you think are the key threats? But ultimately, or more importantly, what do you think are the key opportunities that you are looking forward to? I know we're all hoping for a Fed pivot sometime soon. Is it realistically going to come as early as June? Do you base your decisions on that? And how are you looking at the year sort of on the whole?
Stuart, you made an interesting point there on the debt to GDP, the election year coming up, and half the planet going to the polls. And as a rational investor going into the year, you have a little bit of a knot in your tummy and thinking that maybe this is the year I need to sit and wait in cash and wait for things to calm down. But the reality is things are never really going to calm down when it comes to markets. Every year is going to have noise. It's going to have different forms and different shapes of noise. The fundamentals at the end of the day and the basic principles of investing remains the same, regardless of the macro environment, regardless of how much debt governments carry, regardless of AI making a big noise. So basics of investing remains the same. And if we can stay true to our process, that's the key at the end of the day for investment success. So don't sit on the sidelines, because next year you're going to face different problems. And as Renee mentioned now, if you thought last year the best thing was to sit in cash because we're going to in a recession, you missed out on 10% additional return in a normal global balanced portfolio in dollar terms. And that's quite meaningful in the long run. So no, I don't think fundamentals have changed. I think there's more noise though.
We've had a chat about the global situation, macro, we chatted about elections, we chatted about a few things earlier, but we're now on to Citrine specifically, and that's obviously the SA market is obviously the most important thing, because that's where Citrine invests. So looking at 2024 through a lens of South Africa, again, key threats, key opportunities, what are you guys excited about? What are you a little bit nervous about? And what can we sort of expect to see from Morningstar in 2024?
Stuart, I actually just want to get back to Renee's point earlier, is that risk is the stuff that's left on the table after you think you've thought of everything. So I think in the South African context, we're very conscious of all the risks and the noise out there. But I guess the good news is that everyone's aware of it. Everyone's aware that South Africa's got an energy problem. We've got a Transnet problem. We have uncertainty around politics. Our economy is quite sluggish. We've got high youth unemployment. We've got high unemployment in general. We've got talent leaving the country. I mean, the list goes on. I can sit here for a long time, talk about the list of issues in South Africa, and then filtering that through to a global lens. I mean, globally, South Africa is quite vulnerable, because a lot of what we do is reliant on China and also reliant on the rest of the developed world in terms of having strong economies, and that filtering through to emerging markets, also South Africa. So we're a very vulnerable economy. And if you look at the risks around the world and in SA specific, it makes you want to run for the hills. But I can tell you today that at least the risks that's out there, we know about them. And the important thing is that you don't need an entire new portfolio to deal with each and every one of those risks. And I'll give you an example. Let's say the energy issue continues and we still see quite lackluster performance from the equity market. Consumer sentiment remains low. This has been priced in for many years. So South African assets are as cheap as they were during COVID, actually. So during the COVID crash. So assets are incredibly cheap. Our bond yields are really elevated. So without taking on a massive amount of risk in a portfolio, you still lock in real yields. So those are yields after inflation of 5 or 6%. So your upside is a lot more than your downside. So I always think about it as a lot more can go wrong than will go wrong. And sometimes the market prices that everything will go wrong. And you don't need good news to make money. You just need news to be a little bit less bad. So I think that's the good news for South Africans. And bringing that just back to the Citrine portfolios, if you look at Citrine balanced, on a look-through basis, you mentioned that there's global equities in there, we've got bonds in there, we've got all sorts of asset class exposure. But the true SA equity exposure, if you remove rand hedges, you remove the global equity side, it's only 16% of the portfolio. So it's not that magnificent. But that 16%, don't get me wrong, is very, very cheap and very attractively priced. But not all your exposure sits there. It's actually a very well diversified.
So sticking with Citrine, for those people watching who don't know, it is a range of multi-manager funds. So within Citrine Balanced, let's focus on that. There are a multiple of different managers that focus on specific things. You look for specialists in different categories. With that in mind, how do you manage the diversification element? Is it as simple as just taking managers who do well in different cycles and blending them together? Or is it a case of looking at different sectors and blending them together? How do you achieve sort of the only free lunch in investing, which is diversification?
Yeah, so I think if you go back to the Morningstar process, what we try and do is we first and foremost do our capital markets work, so meaning that we form a view on each and every asset class. Then we try and find managers to express those views. And then the third part of that process is portfolio construction. How do we build a well-calibrated, robust portfolio that's going to perform well regardless of market noise? And the way that we achieve it is to blend different managers with different styles together while still accessing parts of the market that we think is very attractively priced. So I'll give you an example. In the equity core, for example, South African equities are so cheap, so we can access broad-based cheap equities via a tracker, so a passive. And then we style around that with more value managers and more deep value managers to really access pockets of the market that a lot of the big players don't actually play in, and incredibly well priced. Then we go and we find managers that can express a resource view. For example, resources are typically very cheap today. And then we blend that with someone that's a bit more benchmark aware. So you get the dual listed, you get the Naspers of the world in that sort of blend. And together, what we aim to achieve then is to have that consistent outperformance of the category as a whole, but you have that very stable rolling excess return over time, and investors don't have this roller coaster ride. And that's really where robustness comes in. So Citrine portfolio is very well diversified from a manager perspective as well as from an asset allocation perspective. So regardless of all the noise that we see in 2024 and beyond, the portfolio should continue to serve clients well.
Okay, excellent. So final question, over to you, Renee, for this final one. What would you say, in addition to what we've covered, in addition to what we've already covered, very simply, why do you think Citrine is a compelling option for the South African investor?
So if you look at the Citrine range of portfolios, you're getting access to Morningstar's global best investment views, getting access to our research-driven process. And what we really aim to do within these portfolios is give you first and second quartile performance, third and fourth quartile fees, and focus on that stability and not taking any binary bets within the portfolio. So really just that sticking to process, active management, Morningstar's global best investment views, well-diversified portfolios, good returns, low cost.
So Nick, in a very short, snappy, elevator speech type of way, why have you put the majority of your clients, your South African clients, into the Citrine range of portfolios?
Okay, so for the most part, I think we feel that client portfolios have, in some instances, been poorly managed and poorly advised. It's really created the need, particularly in South Africa, for a professional investment approach. Citrine is certainly, by our expectations, managed by the single best discretionary fund manager in South Africa, which is Morningstar. And they have created portfolios which are actively adjusted to suit market conditions. All of the 5 Citrine portfolios across the range that we hold are top quartile over 5 years, and it's just a fantastic achievement. So purpose of me putting clients' money in there is to make sure that we are delivering active year-on-year return for clients with low cost.
It's been astonishing. We've got our 5-year track record on Citrine. So I'll focus on Citrine Balanced in particular, because the Citrine Balanced is in the ASISA category of multi-asset high equity, which is the biggest category in the country. So it's very, very competitive and very saturated. So to compete in that space is enormously challenging. But Citrine Balanced, over a 3-year period, has beaten 95% of its peers in that category, and over a 5-year period has beaten 98% of its peers. So it's nothing short of a stellar performance for our clients. So that brings us to the end of today's webinar. Thank you so much for joining us. I hope you found as much value as I certainly did. I hope you learned a lot from the two ladies from Morningstar. Yeah, thanks for your time. I wish you all the best, and please look out for similar webinars in the future. And yeah, all the best. Take care, and thank you. Bye.